Please like and comment on the video below. That will allow me to produce better quality videos and more of them in the future. If you're interested in learning to trade successfully on sports, then why not visit the BetAngel Academy, where we have more detailed videos. So Cheltenham's over and it's time to come to earth, or back down to earth with a crash. And the trading style that you're going to adopt at these big meetings is going to be very different from what you see on a day-to-day basis typically, and therefore you're going to trade them differently. I've made it no secret that I like those big meetings. Why do I like them? Well, my strike rate is exceptionally high at these big meetings. And if you know that you're very, very likely to get a positive trade out of the meeting, what are you going to do? You're going to stick in 5s and 10s and 20s and 50s? Nope, you're going to go for it. You're going to throw as much money at it as you can. And as a consequence, that's why I like them, because I know I'm probably likely to win, and it's just a question of how hard can I push it. So I push really hard during these big meetings, and that's why I get those big results. But those big results are unusual. Not only are they unusual in the market as a whole, so therefore don't set your bar at a 500-600 quid or consecutive amounts like that. You want to set your bar much lower, and the reason for that is the market generally can't tolerate bigger staking. So when we transition out of a big meeting back to more standard fodder, you're going to have to reappraise the way that you trade. But that's fine, that's exactly what you do. I flex my trading style depending upon what's in front of me. It's a nonsense to say don't trade Cheltenham because there's too much money there. Trade Cheltenham, but just modify how you trade it. And it's the same coming out of a big meeting. There's no way, when I look at the card today, that I'm going to be using 2.5 grand stakes or something to trade a race today, because the market just will not take it. It will do one or two things. It could just stop the activity in the market at that particular point. You know, I'm trying to get an order filled and it won't pass through it. Or the other thing that can happen is that basically the market gets scared and starts running away from your order, and therefore you can't get filled when you're attempting to close your order. So yeah, it's important to understand that you've got to flex in and out depending upon what's in front of you. If the market's got loads of money coming through, you're expecting the amount matched to be very high, then you can increase your stakes and you can really do a lot within that particular market. But if that's not there, then you just pull your risk down by reducing your level of stakes. And you know, while it's lovely to see those big greens that I post, and you know, and I'm posting them regularly through Cheltenham, all I did this year was just pick off one from each individual day, but there were loads all the way through those 28 races. It's not realistic to think that that's typically how the market trades. Maybe at a big meeting, at an Ascot, at the Guineas, or any of those other things, you can sort of expect to get some big totals. But of course, if you're starting out or you're an intermediate trader, you're not going to have enough practice at those big meetings to be able to push really hard. So you're probably not going to get those. The thing that I've noticed at Cheltenham this year is actually the queue size is getting smaller, and that's because the market's getting a little bit more volatile. So that's actually bringing in the opportunity for people to trade it a bit more conventionally, like you see on a day-to-day basis. But as we transition out of those big meetings and into the normal type of trading that you expect to see, it's really more a case of trying to stay out of trouble, not doing anything stupid. But also, when you look at it, it's really a case of trying to get a good result overall. It doesn't sound impressive getting sort of an average of £10 a race when you've just seen me post a P&L of 500 quid that I've managed to achieve at a Cheltenham or a big meeting. However, those are the ones that are really important, because over the course of the year you could easily do 10,000 of those. So if you can average a tenner a race, for example, I'm not saying that you can, and I'm not setting an expectation here, we're saying that you manage to average £10 a race and you're doing 10,000 races, that's obviously a lot of money. So, you know, maybe you don't even need to set your target at that level. You could set it much smaller and still achieve something useful. But the way that it arrives is going to be very different from what you would expect at a major meeting. At a major meeting, I expect a string of profits, and I'm pushing as hard as I can to make those profits as big as possible. Every now and again, I screw up. And you know, one of those races that really should be in a profit, I push too hard and it just falls off the edge of a cliff. So even, you know, it's rare, even though I did do it last year, it's rare to get all of them absolutely correct. You usually mess up on one or two. However, when I'm trading during the week next week, I'm going to be very defensive. I'm going to lower my stakes right down, and I'm just looking not to make any mistakes. And the profit comes from a combination of profits and losses. So it's an overall figure that I'm looking for. I'm not looking to go on some ridiculous run or bag some enormous amounts of profit. The way that I'm going to do it is I'm going to say, you know, I'm going to trade 30, 40 races over the course of the day, and I'm going to end up ahead of things by the end of the day. So for example, if you have a strike rate of 75% and you make a tenner 75% of the time, but you lose £20 25% of the time, you end up plus £10 over the mix of like sort of 10, 20, 30 or so races. So the strike rate and the amount you win and lose are going to interact quite heavily, and the way that they tend to interact is it tends to be uneven. I've given you like a very clear number there, and people love clear defined numbers, but it never works like that. The reality is your P&L is going to be like -5, +10, -7, +20, -30, +75. And it's going to be really, really bumpy all the way along there. And at the end of that, you'll end up with a strike rate, you know, of some level, 60, 70% or something. And it's the mixture of your strike rate and the profits and losses that deliver you the profit at the end of the week. Now, I'm going to bring up a spreadsheet here of some activity way back in 2007. And if you look at the way that the P&L was created, I ended up on a very big total by the end of the month, but that total was made up of loads of little positives and negatives, and I just kept on chipping away. And the methodology that I have is I chip away at the market, and I'm trying to get a profit at relatively low risk. Now, I don't know how that profit is going to arrive. It's basically going to be positive here, negative, positive, 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 negative. And I'm just trying to make a good decision based upon what I see in the market. And believe it or not, generally what I'm trying to do is avoid a loss. I'm trying to get myself in the position where the chance of a loss is much lower. And then profits arrive off of the back of that. That's generally how I tend to trade, trying to get myself into a good position where a loss or a chance of a loss is minimized, and then I'm letting the profit run. And if the profit starts to look good, then I may just push it a little bit harder and try and get that profit a little bit higher. But generally the sequence of events almost looks random. If you look at the progression, if you look at the equity curve over the course of this particular month in January 2007, you can see the equity curve seems to just smoothly go upwards with a little couple of bumps. You get the odd cock up and the odd positive result. But generally the equity curve rises smoothly. But when you look at the individual results, you'll notice that there's a right old mixture in there. Some are, you know, quite positive, some are negative, and it's, you know, there's no clearly defined path. And that is really, if you're trading properly, that's typically what you tend to find. Now, if you wind forward over a number of years, that's more or less exactly the way that my P&L looks outside of a big meeting, in that I'm getting little profits, I'm getting little negatives, and overall it's all coming out in the mix by the end of the week, by the end of the month, by the end of the year. And the advantage of doing it this way is the more markets you trade, then generally the more money that you make. You're generally trying to get as many trades through as possible in as many markets, and the more that you do that, knowing that you have a positive expectancy, means that you typically end up over any particular period. And that's why I like racing, because those positives and negatives balance themselves out really, really quickly. And over the course of the week, you can do pretty well, even though you're probably not going on any particular long winning run, because you're not really going on any particular long losing run either. But the way that the results appear will be sort of not random, because you've got some logic in there, but they're just not coming in a regular pattern, I think is what I'm trying to say here. And that can be frustrating at times, because you can be chipping away for ages and nothing happens, and then you get that big result. Or you could get a nasty negative, and then you just gradually chip away at it with loads of positives. And sometimes this is what catches people out when trading, because it doesn't have that nice smooth approach, and it can be a little bit stressful when you're having a bad day, and when you're having a good day it can lead to overconfidence. So typically my attitude, my desire when we trade on a normal week is just to do the best I can in every individual market, try and minimize where I'm likely to make a loss by maximizing the entry positions within the market and managing the trade well, and I'm just chipping away at each one as frequently as I can to try and end up to a bigger total at the end of whatever period I'm measuring over. Now when you first start, I suggest you measure it over a month, but maybe when you're a bit more experienced you'd want to measure it over a week. But measuring it on an individual day or checking your P&L as the day is progressing is a disaster, because it will influence the way that you trade the next market. Whether you're behind or ahead will lead to overconfidence, or it may alter the way that you trade the next market. So all I do is just chip away at each market, do the best that I can, and then I look at the P&L at the end of the day and go, oh yeah, that went well, or maybe I'll do better tomorrow. But yeah, when you're coming out of a big meeting, don't believe these big meetings are the norm. The mundane stuff is where a lot of the money comes from, and it's going to be small positives and small negatives, but adding up over a period of time. So yeah, prepare yourself for those types of markets now while we wait for the next big meeting. But that's how I'll be looking to trade over the next few weeks.